questions and make one historical observation. The questions are, do our media concentrate too much on economic news? And do they do so more than in other countries? The second question is, does it make us happier and better able to do our jobs and invest our savings? And the observation I want to make is rather similar to the one that the Secretary of the Treasury made and referred to in her introduction, which, far from concerning short-run movements, concerns really long, very fundamental events. Let's get on to the first one. Do we get too much economic news? Well, people with jobs like I have always been receiving a massive amount of information, originally from official sources like the Australian Bureau of Statistics, but more recently from all sorts of private purveyors of survey information, and over the past decades, the general public, I think, has also been inundated with a lot of this information. Newspapers and magazines full of economic news, television reporting saturated with it. There are special radio and television programs devoted to it. It's a worldwide phenomenon. You can turn on a television set in a hotel in the US, Europe or Asia, and here's someone holding forth on the latest movement in exchange rates, share prices or bond yields. Now, while it's a worldwide phenomenon, it is actually, I think, more pronounced in newspaper coverage in Australia than elsewhere. I've often heard foreign visitors make that comment and about how much economic coverage there is in Australian newspapers, particularly on the front page. A few years ago, we did a comparison with the Reserve Bank of how much coverage the central bank monetary policy decision received in 3 countries: Australia, the US and the UK. Remember, of course, the US and the UK contain London and New York, which are the financial centres of the world. So we looked at 3 comparable newspapers in each country. In the UK, we looked at the Financial Times, the Times and the Independent. In the US, we looked at the Wall Street Journal, the New York Times, the Washington Post. And in Australia, we looked at the Financial Review, the Australian and the Sydney Morning Herald. We added up the number of articles in these papers in the 3 days surrounding the 2 successive monetary policy meetings. And our findings were as follows. In the US, 35 articles. In the UK, 46 articles. In Australia, 131 articles. We then looked at how many of these articles were on the front page, the results. The US, 1. The UK, 1. Australia, 14. Why is there so much more coverage in Australia of economic news than elsewhere? Now, one explanation I have heard on several occasions is that there's not as much other news to report. We're not an international power or a trouble spot. We're not engaged in a major war. We're dealing with racial riots, civil insurrections, sectarian violence, and the private lives of our politicians are not as lurid as the British ones, or a recent American president, or several others I won't name. So instead, our newspapers are taken up with recent figures on employment, interest rates, CPI, budget, etc. And of course, with the media competing so strongly against each other, there's inevitably a bias towards sensationalism. There's a tendency to try and extract the maximum amount of coverage out of each tiny little piece of information. Monthly, even daily figures are invested with a significance well beyond their actual information content. Interest rates do not merely rise, they soar, exchange rates dive or plunge, budgets blow out. The reader is left with the impression of constant action and turmoil. And the recurring television image is of people in dealing rooms or on floors of futures exchanges shouting at each other. Well, another feature is the tendency to concentrate on pessimistic news. Now, this is, of course, the nature of all journalism, not just economic journalism. That practitioners seek to expose a disaster or a conspiracy. No one ever wins a prize in journalism by pointing out that things are proceeding relatively smoothly and uneventfully. Hence the tendency to find bad news, mistakes in policy, and to label every minor glitch as a crisis, which is probably the most notable word in journalism. I think at the margin all this tends to make us slightly less confident, less secure, and less happy, less optimistic. That's question number one. Question number two, does it make us better at doing our jobs or investing our savings? The normal first response would be to say, of course it does. I mean, more news must be better than less. More information must be better than less. That's the whole point of the information revolution. Now, it's hard to argue with this point of view in terms of most of the decisions we make in our everyday life. Certainly, a broad range of information is better than a narrow one. But is more frequent information about a particular thing better than less frequent information? That's the question I'm interested in. Is it possible that if we're inundated with more information than we need, we may not be able to, as the old saying says, see the wood for the trees? Or another way of saying this is that we may cover the detail but lose perspective. Or as T.S. Eliot said rather more eloquently, where is the life we have lost in living? Where is the wisdom we have lost in knowledge? Where is the knowledge we have lost in information? I'm not sure what the first line means, but I think the latter two are pretty clear. Another reason why we should question the value of frequent information is that it's subject to a distortion known as the narrative fallacy. This is the need to be able to tell a story as to why a movement in an economic variable occurred, even if it is a very short-term movement. Every day the exchange rate changes, so does the share price index. And every day you will be told why it changed, i.e. what caused them to rise or fall, even if they only went up by a few tenths of a percent. Do we really know the reasons behind these tiny moves, or do we just make up a story? Because we can't bear to say we don't know why they moved. It is often just random noise, but we can't say that. The Reserve Bank meets a meeting every morning at 10 to 9 to review what had happened offshore the previous night. And of course, the thing we're most interested in is the exchange rate. And of course, naturally, it went up or down. And the people of this job was to monitor that. They always had a story. They could never come in and say, oh, it only rose by 0.2%. They always had a sort of ready-made story. Middle Eastern buying, hedge funds selling, profit taking. You know, you can't actually say all this stuff's happening out there and it's just most of it's random noise. And similarly, if you look at monthly statistics, look at retail sales, employment, business confidence, we always feel we have to explain each monthly movement. Although in many cases, in fact I would say possibly in most cases, the change is simply due to sampling. But we can never say that. We've always got to have an explanation. Right, now I want to turn to the question of whether more frequent information enables us to become better decision makers. In particular, whether it makes us better or worse investors. People around here, I'm sure, who are interested in investing, people who have self-managed superannuation funds and things. Some who actually do it professionally. I want to start by saying that several financial advisors I've worked with have told me that amongst their clients, those that spent the most time tracking daily movements in their portfolio did worse on average than those who reviewed their portfolio as frequently. This, of course, is hearsay. To me, it sounds quite plausible. And I'll explain why. It has been established from a lot of experimental research that most people exhibit loss aversion. That is, they experience more unhappiness from losing $100 than they gain happiness from acquiring $100. Approximately twice as much, according to the evidence. So the more often they are made aware of the loss, the more unhappy they become. If the stock market rises by 6% per annum, that plus dividends is a reasonable return, in my view, and should not be a cause of unhappiness. But given the variability of daily movements, on average, about 47% of days, the stock market will fall, and on 53% it will rise. And since we experience so much more unhappiness from the falls than the happiness from the rises, the daily flow of information will result in a net fall in happiness. I'm not joking, this is serious research. If we review the market on a monthly basis, there will be a smaller proportion of losses and a larger proportion of gains, so we will be happier. Now what this shows is that more frequent information makes us less happy, but it does not necessarily mean we become worse investors. I'll go on to that now. There is a body of research in behavioural finance conducted by experimental psychologists that show that more frequent information also makes us worse investors. This is because we tend to suffer from myopia, which I've already described, which is reading too much into very short-term movements, and loss aversion, again I've already described that. And this research concluded that, quote, investors who got the most frequent feedback and thus the most information took the least risk and thus earned the least money. Now this is very serious research. Economists, like me, usually don't like being lectured to by psychologists. But the two who conducted this research, Kahneman and Tversky, were the only two economists ever to win the Nobel Prize for economics. Unfortunately, the latter died before he received it. Now these experiments are done with real people and real money. I'll give a brief summary of how they worked. In the experiment, the subjects are able to invest in two asset classes. One which we may call equities, which has a higher average return, but a lot more volatility. The other which we call bonds, which has a lower average return, but not much volatility. The investors in the experiment who receive daily information avoid short-term losses by buying more bonds and less equities than those who receive monthly or quarterly information, and so as a result they earn a lower return over the long run by trying to avoid these losses. A similar finding results even if the subjects are only able to invest in equities. Those who receive daily information are inclined to act on it and overtrade. The resulting increase in transaction costs lowers their return relative to those who receive less frequent information. So I think we can conclude that too much information, or more correctly, too frequent receipt of the same information reduces the recipient's happiness and leads them to make inferior investment decisions. Now that brings me to the third point, which is totally unrelated to the first two, because I want now look at very long run events, the opposite of short run, very long run. I want to look at changes that take decades, generations, or even centuries. This, of course, is mainly of historical interest, because it's probably impossible for a fund manager to keep money out of things that occur so slowly. Have you ever wondered how it was possible a century ago for so many magnificent homesteads to be built in rural Australia? The National Trust has put out some terrific books on these homesteads. Why were some farmers a century ago able to build these mansions? The answer is that the price of wool was so high that the owner of a large sheep station could afford to build a mansion and start with the service. It turns out that changes in the prices of what we produce can explain a lot about how economies and countries evolve. The example I gave there was a rather minor one. I'll give you a couple of bigger ones. In 1667, under the Treaty of Breda, the Dutch government gave up their claim on Manhattan to the English in order to retain the island of Run. Now, how many people know where the island of Run is? Someone must. Yeah, right, in what's now Indonesia. I'm sure they might reverse the swap now, but they can't. Why did they prefer the island of Run? because it was the world's main source of nothing, which was highly prized in Europe and extremely expensive. How many of you have consumed nothing in the last week? I don't know. You can buy a 30-gram jar of Woolies for $2.50. In the late 18th century, France had only enough armed forces to protect one of its two major possessions in the Americas. It had to choose between Canada and Haiti. It chose Haiti. Why? Because the price of sugar was so high that more wealth could be extracted from a tiny island in the whole of Canada. Again, I think they chose differently today. I don't know whether Napoleon was involved in that decision, maybe he was. He certainly was responsible for what today seems an extremely unprofitable decision, the Louisiana Purchase of 1803. Under this transaction, France sold to the United States a large tract of land west of the Mississippi, which doubled the size of the US. The price of $15 million was cheap, even by the standards of the time. Probably didn't contain nutmeg or sugar. What is the significance of this sort of long-run development for Australia? I touched on it before when I observed the magnificent rural homesteads of the late 19th century. Unfortunately, that type of wealth did not last. From about 1900, the trend of prices for what we in this country exported, which was mainly agricultural and mineral products, either fell or at least didn't rise as fast as the prices of the goods we imported, mainly manufactured. This was because the supply of agricultural and mineral products could easily be expanded by bringing new areas on stream or by raising productivity. In economic parlance, Australia experienced a trend fall in its terms of trade, and this made the country less wealthy than it would otherwise have been. In other words, the prices of what we produced and sold did not go up anywhere near as much as the prices of what we consumed and imported. That's what the terms of trade is all about. Now, as we all know from our daily papers, that has all changed. The terms of trade have risen to an all-time high. The mining sector is booming. Agriculture is looking up. Is this just a cyclical event, or has something more fundamental changed that means it is more permanent? A famous investor said that the four most dangerous words in investing are, "It's different this time." Is he right? And should we expect a return to the old pattern? Or is it different now? Well, I think it really is different now. The long decline in the terms of trade ended in about 1985, and a hesitant upward trend commenced. Then over the past half-dozen years, notwithstanding the financial crisis, the terms of trade have gone through the roof. Why has the downward trend of 80 years been so comprehensively reversed? I think you all know the answer. Essentially, it is because of the emergence of the developing countries as a major economic force. First it was Taiwan, Korea, Hong Kong, Singapore, then Malaysia, Thailand, Indonesia, and finally the big one, China, followed shortly by India. This simultaneously provides us in Australia with cheap manufactured goods to buy and increases the demand for our exports as an input into their manufacturing processes. Of course, it could all fall apart, but I don't think that is very likely. It is relatively easy for countries like China to keep growing when they're starting from such a low base, and when they are able to adopt the technology that has already been invented by others. Besides, a world where China and India play a major role is not really new. It's a return to an earlier time. Until the Industrial Revolution of the late 1700s, China and India accounted for most of the world's GDP, and their incomes per head, i.e. their standard of living, were much the same as Europe. Looking back in 100 years' time, we may view the 1800s and the 1900s as an aberration, where some countries with relatively small populations in Europe and North America, and us, outpaced their larger rivals for a time. So I'm inclined to agree with what the Secretary said. Where does all this leave Australia? Well, in a very favourable position, I would say. It doesn't mean we won't see some future falls in export prices. That is almost inevitable. We're digging iron ore out of the ground at $30 a tonne. The world price is $180 a tonne. That can't last. But on average, I think these prices will still be high by historical standards. It also doesn't mean that the current expansion will continue indefinitely. The business cycle will reassert itself at some point. I've been saying that for a while, but it hasn't. We've had nearly 20 years of expansion, which is quite astonishing. We've never had that before. Anyhow, by the standards of other developed countries, we will remain in a very favourable position. Now, I want to conclude by reminding you that it is still possible to squander a great opportunity if the wrong policies are followed. Argentina is a classic example of this. It had about the same income per head as Australia in 1900, but now it's only $100,000. I'm reasonably confident we won't make their mistakes, but I know in the past that the Australian political process has actually handled adversity well, but prosperity not so well. We now have to learn how to keep in place the policies that will enable us to realise the prosperity that our place in the world opens up to us. Thank you very much.
As the Mayor mentioned earlier, we're going to have a Q&A session. If there's anyone that would like to ask a question, so I'll just bring the microphone to you.
Getting back to the main things in our lives, could you tell us what you think of the future of Mosman house pricing?
Well, there's two schools of thought here. I have, outside Australia, there's a lot of people who think that there's been a bubble in Australia that will be collapsed. I don't think that is likely. I think the countries where there was a real collapse in house prices were those countries where there was a collapse in lending standards. The United States was a classic example, where they lent you, well, we won't even go through some of the things they did there. They were just mind-blowing, like lending you 110%, and you don't even have to pay interest, for the next number of years. We never had that. So I don't think there's a bubble that bursts. On the other hand, house prices have edged down a bit over the last year. And I, myself, think that we're in for a period of flatness, possibly minor falls. I wouldn't be rushing out to need a year of property at the moment. I think that the outlook for the next 3-4 years is pretty restrained. But on the other hand, I don't see a collapse. I didn't hear that, sorry?
I didn't quite understand the last thing you said. Sorry, I didn't understand the last sentence you made.
Oh, the last sentence is I said, as an investor, I would not be gearing up to buy property at the moment. I think, and I think we can see that there actually aren't that many. In fact, it's quite amazing at the moment how lending to the household sector has slowed, and lending for mortgage lending is growing at about 6% per annum. And as long as I can remember, it was always in double figures. So I think the household sector in Australia is actually becoming more conservative. We can see that in the slowdown in retail sales. We can see that in their less willingness to go out and take on debt. And we can see that in the fact that house prices have reached back over the last year. But I think that's a welcome development. It's not something I worry about. In fact, I was looking forward to that happening. And it just sort of didn't happen, but now it's finally happening.
Thank you. As an investor, I'm always a bit worried when major companies I invest in go overseas for major investments. You, I believe, are a direction of Woolworths, ANZ and Leighton's, amongst others. And Leighton's, of course, has suffered a bit. I don't know how much overseas versus home. I suspect overseas quite a lot. Woolworths, a lot of people see it as a good investment because it doesn't go overseas very much. ANZ, of course, is now expanding in China. Could you please give us your views on companies that invest overseas and what the issues are there?
Well, Peter, I think we had some bad experiences in Australia in the late 80s and early 90s when we had all sorts of people doing stupid things overseas, including banks, including the Alan Bonds of this world, and a number of people who did not have a coherent business model. I think there are others who have done it very well. Leighton's has been overseas for 35 years, and despite the setback at the moment, has done remarkably well over that time. Westfield is spectacular international success. Some of the building products companies have done very well. I think it's too pessimistic, Peter, to say, oh, we should only say no. I think there are companies in Australia that are world first best practice, and they're very careful about it, and they don't rush in, and they don't pay too much. They can do well by expanding offshore. I'm on board the ANZ, and I support the policy of the ANZ becoming a regional bank. It's not trying to become a global bank, it's trying to become a regional bank, which follows Australian trade flows around Asia. So I know there are a lot of investors who penalise companies if they think they're going overseas, but I think that is too defeatist and too pessimistic. I think good companies can do it, and the current set of companies have done so much better than the ones who did it in the late 80s and early 90s.
Philip Higginson speaking again. I enjoyed your address. I'd like to ask a question about the governance structure of the central bank in Australia. And I work for a company that was started by the central bank in the UK, the Bank of England. Contemporary corporate governance would say that you split the role of the chairman and the CEO of an entity. You have an independent non-executive chairman and an executive managing director. What's the governance structure at the Reserve Bank? I suspect that the governor is both the chairman and the chief executive. And would you still say that that's the right model? There's not a listed company in Australia that doesn't have an independent chairman, nor in the UK, certainly the top 100 anyhow. And to what extent, just a supplementary question please, to what extent is the bank influenced by the government of the day?
On the first one, I totally agree. If you have a multitude of shareholders, as most public listed companies do, you should have an independent chairman. If, however, you have one shareholder and you're not a public listed company, and that shareholder is fully able to look after itself within the framework of an Act of Parliament, I think it would be a mistake to have a chairman and a CEO. I think people would wonder who is speaking for the bank. I was on the board of Macfarlane at one stage when they had a chairman and a CEO and it didn't work. They were the same with the Reserve Bank in the sense that they had one shareholder, which is the Australian government. So I agree with you entirely if it's a publicly listed company and there's Australian shareholders. On the other hand, if it's not a listed company and there's only one shareholder, splitting the role doesn't work. On the other issue of the influence that the government can exert, I think people are aware that for most of the post-war period in Australia, monetary policy policy was sort of effectively made in Canberra. It was made as part of the process, and this had the effect of actually meaning that it was pretty ineffective. Governments were terrified of putting up interest rates, so instead of doing it in time to fashion, they tended to wait until the evidence was actually overwhelming, which meant that they were always behind the game. In 1996, the Treasurer, Stella, and I signed a document which it actually reasserted what was already in the Act, that the Reserve Bank has independence to conduct monetary policy. It doesn't have independence to do anything else. Everything else it does in cooperation with the government, but the actual decision, monetary policy decision, what do we do with interest rates this month, is done by the Reserve Bank. And treasurers often don't like it, and much as I admire our former Treasurer, Peter Costello, there were a lot of arguments on that subject, always amicable arguments, but at the end of the day, the Reserve Bank, he understood what the Reserve Bank was making. And in fact, deep down, the governments are happy that way. Deep down, they knew that it never helped them at all being responsible for interest rates. It was much better than delegated to an independent institution. The system's worked so much better since that was finally sorted out.
Ian, I think one of the concerns, you talked about a boom that's happening, resources-based, but one of the concerns with a federal structure in Australia is that we are potentially facing a situation where we've got 2 or 3 speed economies and very limited tools at a federal level, such as the interest rate, to be able to deal with the pressures of different speeds and different economic situations across the country. Do you share a concern that maybe we will face a somewhat of a bottleneck or a train wreck coming down the line where, yes, the resources boom may be driving success for some parts of Australia, but we don't have the tools to enable the whole country to be able to respond and adapt as it needs to what is a pressure that it can't respond to?
Well, all countries have fast and slow growing regions. In the US, there's no reason why California and Mississippi should be growing at the same rate. And they're often wildly different. Canada is more extreme than Australia. The prairie provinces are absolute resource provinces, and the Maritimes are the exact opposite. They're old-fashioned like Europe. It's inevitable, not just in a federation like Australia, Canada, and the US, but even in a unitary country like France or the UK, that bits will be growing faster than other bits. And nothing monetary policy can do about it. You have the one monetary policy for the whole country, and it's impossible to devise unless you gave the other states their own currency, which we're not going to do. They have to have the same monetary policy. So if the situation needs redressing and has to be done through fiscal policy, Australia has addressed this over the decades. We have a system for fiscal equalisation. So the poorer parts of the country get a bigger share of the tax revenues than the richer parts of the country. And I think we handle this about as well as it can be handled. But there is nothing, and there's not a lot more that can be done. Although I have to say, I think if we had found a more efficient form of taxing the economic rents of the mineral producers, that would have been helpful. I think that was mishandled politically. Economically, it makes a lot of sense to do as we do with petroleum production and have a resource rent tax, and to great shame that the politics of that was so badly handled that we're going to end up with something which is much inferior to what we could have. That would have been a help. But the main help is through fiscal policy and fiscal equalisation. And monetary policy can't do anything about it. Never could, never will.
I might paraphrase and say, said the Chinese made up for a putt. It could do it, which would affect our budget. But the other thing which is concerned is Greece and the knock-on effect from there, particularly the banking sector.
Yeah, well, I mean, Greece is a classic example of what not to do. So it's worth looking at it for that reason. But I think financial markets have grossly overreacted to Greece. It's a time and place. It's so Victoria. And the fact that it dominated the headlines of the newspapers for about 3 months is astonishing. But it is a basket case. And it's a failure, a total failure of fiscal policy. People in Greece don't pay the taxes. And yet they expect the government to provide a whole lot of services, so you have a massive budget deficit, and you have to try and borrow to cover the deficit. And if they haven't had to borrow in drachma, they would never have been able to do it. But because they could borrow in euro, they were able to end up running these huge budget deficits, which has now got them into a situation where there's no way out other than default. But we'll call it restructuring or something like that, it's a better word. But basically they can't pay the debt. There's no way. But it's so small in the world scheme of things that it shouldn't matter. I mean, I've seen this happen with big countries. We used to find it perfectly common to wake up and discover Brazil or Mexico or Argentina or something. They're serious countries. And they've never got the coverage the time that Greece is getting.
Could I be selfish as a journalist and take you back to the subject of the original speech and those amazing 131 articles about your changes in the interest level? I wonder what the psychology of that is in your view. Is it because we have an awful lot of day traders? We are perhaps a nation of gamblers, and that's why we have 20 pages on sport as we do on money, and far too few pages on the arts. Or do you see any other reason related to Reaganomics and the development of that side of capitalism?
No, I don't think so, because if that were the case, the US would have much more than us. I think the best I can come up with is what I said. It's a pretty peaceful place, and things work reasonably well. We don't have these, tumultuous events happening, but we have a very competitive press, and that's what they talk about. Now, there's a good side to it as well as a bad side. The good side is that the average Australian is actually quite economically literate by world standards. They do. All this constant stuff about budget deficits and interest rates, people absorb it. And I hate to say this, but it's probably actually had a good effect in the medium term. And that people can understand why you can't just run large budget deficits year after year. And so we have actually got the best fiscal policy in the OECD area. We had years of surplus. We legitimately had a deficit when the financial crisis hit. That was the correct thing to do. According to the budget, we're going to be back into surplus again in 2 years. That is just unbelievably good compared to virtually any other OECD country. The only other country that compared with us is Norway, because they've got all this oil and gas. But when we look at the countries that used to preach to us, the UK, the US, even Germany, I mean, their performance on fiscal policy, on economic growth, on monetary policy is much inferior to Australia. I think it turns out that we were actually able to take some tough decisions a lot more easily than European countries or the United States. And I think it's not the frequency of coverage, but the fact that there is a lot of discussion at a reasonable level of depth means that we actually do have quite an economically literate population. And that has made it easier for governments of both persuasion to at times take tough decisions.
And what, if anything, is likely to be the long-term effect on the standard of living of Australian people of increasing foreign ownership of arable land and resources.
I don't know whether I can answer that. I don't really know the answer. Other than, I thought what I can say is we actually also buy a lot of other people's resources. Particularly with our big superannuation industry, we are heavy owners of equities around the world, and also heavy owners of infrastructure around the world, ports, airports, roads, things like that. So my inclination is to say that it'll all come out in the wash. They buy some of our stuff and we buy some of their stuff. And as long as we don't buy the wrong stuff, and they buy the right stuff. And I think, you know, I'd hate to say that we're so stupid that we would do that. I don't think we will. I think we've got enough smart people that this sort of internationalisation of the ownership of resources probably benefits everyone.
At what point, so would we become deliriously happy in Mosman if we banned, for instance, the Financial Review, if it was unable to cross the border? If in fact the Economist was the last resort news of any economic issue?
Well, I think what I'm saying is, I'm not arguing against economic analysis in newspapers. I like it, I read it. What I'm arguing against is making too much about daily movements and weekly movements in variables. In-depth stuff is fantastic. Just the trivialisation of these small movements is what I